There's a setup forming on euro to US dollar right now that 90% of traders are going to misread, and it's going to cost them. We just printed a fresh 2-month low. Momentum is screaming lower on every single higher time frame, and yet somehow the 1-hour chart is lighting up with a strong buy signal. That is the trap. That is the exact kind of divergence that pulls in early reversal traders, shakes them out, and then hands the real money to the patient institutional flow. Right now you're looking at a danger zone and a hidden opportunity running in parallel, and I'm going to give you both with surgical precision. Stay all the way through because I'm handing you 3 exact levels you can trade today, with entry triggers, stop losses, and on-screen trade plans that you can screenshot right off the video. Let's get into it. First, the instant market verdict. Right now my session bias is fading the bounce. That 1-hour strong buy is a counter-trend reaction inside a daily, weekly, and monthly strong sell structure. ADX is sitting at 47.6, which is screaming trend strength. We are not in a bottoming environment. We are in a trend continuation environment where every intraday pop is being sold. Until we see a definitive structural shift, I am only looking for short entries on rallies into resistance. The single invalidation level that flips my entire bias is 1.1445. Write this number down. If euro to US dollar manages a 4-hour close above 1.1445, the whole bearish structure resets, and suddenly we're talking about a much deeper short covering rally. But as long as that level holds, every bounce is a selling opportunity. Here's the micro insight about where the herd is positioned. Retail sentiment data is showing a massive pile-on of short positions after the breakdown, and when everyone is already leaning the same way, you get these violent intraday squeezes exactly like the one we are seeing now. The 1.1355 pivot level just acted as a springboard, but that spring is made of rubber bands, not steel. Once the short covering exhausts itself, the real flow steps back in and drives continuation. So my verdict: we fade the intraday rally, target the downside supports, and keep a close eye on 1.1445 as the bear trap breaker. Drop the number 1.1445 in the comments right now if you're locked in. Let's go deep into the technicals, because this is where the chart tells a story that most people skip. Start on the weekly time frame. We are in a strong sell condition. Prices sliced through the 200-week moving average months ago, and we've been stair-stepping lower ever since. The 1.1500 area, which used to be massive support, now sits overhead as resistance, and price is trading well below the 50-week MA. That alone tells you the path of least resistance is down. Drop down to the daily chart and the picture gets even clearer. The daily trend is also strong sell. The 20-day moving average is at 1.1503. The 50-day at 1.1579, and the 200-day at 1.1576. Price is underneath every single major daily moving average, and just yesterday we got a rejection right at the 5-day MA, which is now sloping lower at 1.1402. When price can't even muster a daily close above the 5-day average, you know selling pressure is intense. RSI on the daily is down at 30.1. Deep in oversold territory, but here's the critical point. Oversold in a strong trend is not a buy signal, it's a sign of momentum. The stochastic is at 29.2, Williams %R is at minus 82.8, and MACD is printing minus 0.007 and still accelerating lower. There is no bullish divergence yet. Price is making lower lows and oscillators are confirming. That is a textbook bearish continuation structure. Now move to the 4-hour chart, and this is where the hidden divergence appears that most traders miss. The 5-hour trend is strong sell, but the most recent swing low was accompanied by a CCI reading of minus 130.7, extremely oversold, and yet price only managed a tepid bounce to 1.1385. That's weakness. A healthy bounce from oversold conditions would have recaptured the pivot and tested the 20-period MA on the 4-hour. It didn't. Instead, we are coiling just beneath the 1.1385 resistance, with the 1-hour chart showing a strong buy that is already stalling at the first supply zone. This is a classic momentum divergence between the 1-hour excitement and the 4-hour exhaustion. The 1-hour buyers are pushing, but they're running into a brick wall of higher timeframe sellers. When you see a lower timeframe buying into a higher timeframe resistance without volume expansion, that's a liquidity grab, not a reversal. The daily support at 1.1325 is the line in the sand. That level is the current monthly low, and a breakdown there opens the trapdoor toward 1.1295 and then 1.1265, which aligns with the S3 pivot. On the upside, resistance is layered at 1.1385, then 1.1415, and finally the line that separates the bears from the bull trap at 1.1445. Every single one of these levels is drawing institutional orders. Here's what most traders miss. The 200-day moving average might be far away at 1.1576, but the gravitational pull of that level is already affecting order flow. Option barriers are stacked between 1.1400 and 1.1450, and dealer hedging is pinning price action into a compression zone. The cross-asset linkage reinforces this. The US dollar index is building a base right on the 105 handle, and if DXY punches through 105, euro to US dollar will accelerate toward 1.12 with almost no friction. Real yield spreads between the US and Germany are blowing out to levels not seen in months, and that is the jet fuel behind this move. Gold is bid on geopolitical fear, but the euro can't catch a safe haven bid because the ECB is still telegraphing a pause while the Fed is leaning hawkish. That's the fundamental driver, and it's punching straight through the charts. Now let's connect the news to the price action. In the last 24 hours, the core shift came from Bank of America cutting its euro forecasts and explicitly calling for a stronger dollar in the second half on a hawkish federation. That single headline lit a fire under the Fed ECB policy divergence trade. The market is repricing rate differentials aggressively. When a Tier 1 bank puts out a revision like that, it's not an opinion. It's a signal that client flow is already one way. Analyst sentiment has coalesced around the theme that euro to US dollar weakness reflects a wider Fed ECB divide, and that narrative has room to run for at least another 1 to 2 weeks. The 2-year yield spread between US Treasuries and German bonds is the best real-time proxy for this trade, and it's widening sharply. That spread is moving tick for tick with euro to US dollar lower, and until that dynamic reverses, buying euros is like trying to catch a falling knife with oven mitts. The 1 to 2 week directional lean is therefore short biased, targeting the 1.1265 to 1.1200 zone. The event that would invalidate this lean is a sudden dovish pivot from a Fed speaker, or a US data miss so severe that it forces a repricing of rate expectations. Barring that, the path is lower. I want to hear from you. Do you think the dollar breaks 105 this week? Comment yes or no right now. I'm tracking consensus and I'll feature the most accurate calls in tomorrow's video. Now we get to the section most people skip, and that's exactly where the money is made. I'm going to give you 3 trade setups with exact trigger prices, stops, and targets, and then I'm going to show you the on-screen trade plan graphic so you can screenshot it and have it locked and loaded. Keep watching, because Strategy 2 includes a trailing stop rule that will bank you the full extension. Strategy 1, the sniper. This is the conservative, high-probability setup built for patience. The idea is to sell into a rally that runs into the resistance cluster and shows clear rejection. The precise trigger condition is this: wait for euro to US dollar to push into the 1.1415 to 1.1430 zone. We need to see a 4-hour candle close back below 1.1400 after piercing that zone. That confirms the rejection. Entry is on the candle close at 1.1398. Stop loss goes at 1.1460, which is above the R3 resistance and the critical 1.1445 invalidation, giving the trade breathing room above the option barrier. Take profit 1 is 1.1325, the current monthly low. Take profit 2 is 1.1265, which lines up with the S3 pivot and the next liquidity pull. The risk on this trade is about 62 pips, the reward to TP1 is 73 pips, and to TP2 it's 133 pips, giving us a risk-reward ratio of approximately 1 to 2.1 overall, or roughly 1 to 1.2 to the first target. But if you scale out partially, the math turns heavily in your favor. Invalidation note. Void the setup entirely if a 4-hour candle closes above 1.1445. That's the line that says the bears have lost control. Once you're in, set your alert at 1.1440 and walk away. The sniper. Entry. 1.1398. 4H close below after spike into 1.1415 to 1.1430. Stop loss. 1.1460 take profit 1. 1.1325 take profit 2. 1.1265 risk reward. (1 colon 2.1 are invalidation. Void if 4H candle closes above 1.1445. Now strategy 2, the active trader. This is the standard approach for anyone who wants to catch the breakdown without chasing price. The setup relies on the pivot level 1.1355. Once price breaks below 1.1355 with a 5-minute close, we wait for a retest of that broken pivot as new resistance. Entry is on a bearish rejection at 1.1355, ideally confirmed by a shooting star or a failed attempt to get back above. Stop loss sits at 1.1390, which is just above today's high, and a 1.1385 resistance, tight enough to give a solid risk structure. Take profit 1 is 1.1295, the S2 support. Take profit 2 is 1.1265. Here's the trailing stop rule. Once price reaches 1.1325, move your stop loss to break even. Then, once 1.1295 hits, trail your stop manually on the 1-hour candle lows, locking in profit as the move extends. This transforms a good trade into a great one. The risk is 35 pips, TP1 offers 60 pips, and TP2 gives 90 pips. Risk reward is approximately 1 to 1.7 on the first target, but with the trail, the realized reward typically stretches beyond 1 minute and 2.5 seconds. This strategy works best during the London and New York overlap when volume spikes to the active trader, entry, 1.1355, on retest after 5 minutes break below, stop loss, 1.1390 take profit 1, 1.1295 take profit 2, 1.1265 risk, reward, (1 colon 2.5 R with trail invalidation. Void if 1H candle closes back above 1.1385. Type your euro to US dollar range for tomorrow in the comments now. Are you seeing 1.1320 or 1.1420 first? Let's see who's aligned with the order flow strategy 3, the aggressor. This is the high-risk counter-trend play for traders who can lose small and manage risk aggressively. It's based on the extreme 1-hour oversold bounce that may have one more push left before the sellers crush it. We only take this long if price pulls back to the 1.1325 support and prints a clear bullish divergence on the 1-hour RSI, where price makes a lower low but the oscillator makes a higher low. Entry is at 1.1328 with a tight stop loss at 1.1290, just below S2. The target is a quick scalp to 1.1385, and if momentum is fierce, a runner to 1.1415. This is a pure mean reversion trade against the daily trend, and the risk is high because if the floor breaks, you're caught in a free fall. Only risk capital you are 100% comfortable losing, and never hold this through a news event. The stop is 38 pips, TP1 offers 57 pips, giving a 1 minute and 1.5 seconds reward, but the probability is lower than the short setups. This is a scalper's trade, not a swing position. Execution speed is everything. The aggressor, high risk entry, 1.1328, on 1H bullish divergence at support, stop loss, 1.1290 take profit 1, 1.1385 take profit 2, 1.1415, optional runner, risk, reward, (1 colon 1.5 R invalidation. Void if 4H candle closes below 1.1295. Let's talk risk management. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news events. Check the economic calendar. Make sure you're not holding through Fed speeches or US data. Stops are non-negotiable. This is how you survive to trade the next big move. Preserve your capital so that when the one-way trend finally emerges, You are still in the game. Here's the close and the retention loop. The single most critical level for the next session is 1.1445. As long as that holds, every rally is a reloading opportunity for shorts. If it breaks, we flip the script and buy a dollar pullback. Tomorrow's wildcard is the US core PCE data and any surprise Fed rhetoric that could compress or expand the yield spread. I'll be on top of it in the next video covering the S&P 500 liquidity structure and how the gamma levels are mapping to a potential equities melt-up that could drag everything else with it. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.